Have we just entered a bull market? Or is it all just a load of We have been carefully analyzing the market during its 20% upswing and have created a three-part blueprint for you to follow in order to navigate the coming months. But first, let's understand what we really mean by a bull market. The term is frequently tossed around, yet its meaning is often misunderstood or oversimplified. The commonly accepted definition is that a bull market is one that has risen 20% from its last low point, indicating an upward trend in the market. However, this definition, while convenient, is flawed and can be misleading. The core issue is the belief that future market performance can be predicted solely based on past trends. The market, as any experienced investor knows, is not linear. It has ups and downs driven by countless variables from geopolitical events to technological advancements, corporate earnings, and much more. So, when we say bull market, we're really talking about a time when stock prices are expected to go up, people feel good about investing, and the overall mood is positive. But why exactly has the market gone up in recent months? Well, put simply, the economy is in a stronger position than it was a year or 6 months ago. This is likely due to a few key factors: the resolution of the debt ceiling crisis, the hopeful anticipation that the Federal Reserve might hold off on raising interest rates at its June meeting, and a recent series of positive economic data reports. Also, a major portion of the S&P 500, technology stocks, has seen a huge surge in recent months thanks to increased attraction to companies linked with AI. With the emergence of ChatGPT, AI has become the talk of the town on Wall Street. Investors are enthusiastically backing giants like Google, Meta, Apple, Amazon, and Nvidia, believing that these companies can spearhead a fresh wave of evolution with this technology. Let's say we are heading into a bull market. How should you tackle it? Here's where our three-part blueprint comes into play. And it starts with part 1. Stay away from the hype. In the midst of the dot-com bubble of the late 90s, where internet stocks were the latest hype, Warren Buffett stood his ground. Despite the frenzy, he stuck to his value investing principles. While others were investing in internet companies with no profits or even revenues, Buffett continued to invest in companies with solid fundamentals and intrinsic value. His approach drew criticism in the short term, as Berkshire Hathaway's portfolio underperformed the soaring tech stocks. However, when the dot-com bubble burst, those who had bought into the hype suffered enormous losses, while Buffett's investments remained solid. When the market is on the rise and every stock seems to be skyrocketing, it can be easy to get drawn into the excitement and make investment decisions based on trends rather than fundamentals. But that's a mistake. Instead, follow Buffett's lead. Ignore the noise and concentrate on the intrinsic value of a company. Value investing requires patience and discipline, but it's a proven strategy that can yield significant rewards in the long term. Keep in mind that finding value in a bull market can be challenging, as many stocks may be overpriced due to the overall optimism. However, there are always opportunities out there for diligent investors. And that leads us on to part 2. Invest in high-quality businesses. Peter Lynch, another investment titan, advocates for long-term investments in high-quality businesses. These are the companies with a proven track record of performance, solid management, and a strong business model. Peter Lynch's investment in the automotive company Pep Boys serves as a prime example of his strategy. Lynch describes how he spotted the potential in Pep Boys during a family road trip. He noticed the company's stores were always packed with customers, and he was impressed by their service. After some research, he decided to invest, and it ended up being one of his most successful investments. As the manager of the Magellan Fund at Fidelity Investments from 1977 to 1990, Lynch averaged a 29.2% annual return, consistently more than doubling the S&P 500 market index and making it the best-performing mutual fund in the world during his tenure. Investing in high-quality businesses is especially important in a bull market because it provides some level of protection against future market downturns. These companies are more likely to withstand market volatility and come out strong on the other side. Look for stocks that have strong fundamentals such as solid earnings, low debt, and a good moat. And finally, we have part 3. Take a phased approach. In a bull market, especially in the early stages, prices can be quite volatile. A phased approach, like dollar cost averaging, DCA, can be a smart strategy in such situations. With DCA, you invest a fixed amount of money at regular intervals, regardless of the price of the shares. This approach can mitigate the impact of volatility and reduce the risk of making a large investment just before a market downturn. Also, it's essential to keep an eye on valuations. If they seem to be too high compared to historical averages or the company's earnings prospects, it might be time to take some profits. This doesn't mean you should try to time the market, but rather be mindful of the price you're paying for a stock. Remember, the goal is not to sell at the absolute peak, but to make a reasonable profit while reducing the risk of significant losses. An example of this was when Buffett's company, Berkshire Hathaway, was steadily buying shares in Wells Fargo, a major player in the mortgage industry, throughout the late 80s and 90s. However, during the peak of the housing bubble from 2005 to 2007, instead of doubling down on this position like many investors did, Buffett took a phased approach. He neither significantly increased his position, nor did he sell out, even when the market was on a bullish run and valuations of banks were sky high. When the housing bubble burst and the market entered a bearish phase during the 2008 financial crisis, Wells Fargo's shares dropped significantly. But Buffett, having taken a phased approach and not having overcommitted during the peak of the bull market, was in a position to buy more shares at a lower price. And there you have it, a three-step blueprint to investing success during a bull run. Make sure to subscribe and support the channel if you found this useful, and we'll see you in the next video. This is not financial advice and are just general strategies. It's important to tailor your investment approach based on your specific circumstances, financial goals, and risk tolerance. Always do your own research or consider consulting with a financial advisor before making investment decisions.